As tensions rise in the Middle East, the global economy faces a tumultuous week ahead. From a sharp sell-off in chip stocks to inflation surging past 4%, the impacts are far-reaching. Here are today's top 10 stories you need to know. Boeing's defense workers are set to strike, marking the first labor action since 1996. This decision comes amid ongoing disputes over pay and working conditions in a crucial sector of the aerospace industry. The strike could potentially disrupt production schedules, leading to delays in military contracts. Boeing has faced challenges in recent years, from production issues to supply chain constraints. The defense sector has seen increased demand, but labor unrest may hinder growth prospects. Analysts are closely monitoring this situation, as any significant disruption could impact earnings projections for the upcoming quarters. The timing of the strike aligns with heightened geopolitical tensions that may also affect defense spending. As negotiations continue, both sides appear entrenched in their positions. The outcome will not only influence Boeing's operations, but may also have broader implications for labor relations in the aerospace sector. In a bid to stabilize the market, Chinese state-owned firms China Reform Holdings and China Chengtong Holdings have purchased equities following a severe sell-off. This intervention comes as markets face heightened volatility, particularly in technology sectors. The buy-in reflects a proactive measure by the Chinese government to support investor confidence amid global economic uncertainty. The recent decline in tech stocks, especially in AI, has raised alarms about the sustainability of growth. These purchases signal a commitment to stabilizing the market, but the long-term effectiveness remains in question. Concerns over Chinese tech IPOs are also evident, with demand cooling compared to previous years. As the global economy grapples with inflation and geopolitical tensions, the impact of these purchases will be closely scrutinized. Investors are watching to see whether this move will boost market sentiment or if deeper issues persist. Apple and Amazon have both reported mixed earnings results, sending ripples through the tech sector. Apple exceeded revenue expectations by nearly $5 billion, signaling strong demand for its products. This performance has buoyed its stock, indicating resilience in consumer tech amid rising inflation. However, Amazon's earnings report was less favorable, with shares declining as investors reacted to cautious guidance. The disparity between these two tech giants illustrates the varying impacts of economic conditions on their operations. Analysts are particularly concerned about Amazon's future growth potential in a high-interest rate environment. This mixed bag raises questions about the overall health of the tech sector, especially as consumer spending habits shift. As we look forward, the performance of these companies will play a crucial role in shaping market sentiment in the coming weeks. As earnings season progresses, Alphabet and Intel are poised to impact the market significantly. Both companies are crucial players in the tech and AI sectors, and their upcoming results are highly anticipated by investors. Analysts are eager to see if these tech giants can meet or exceed profit expectations. The performance of Alphabet and Intel will likely influence the direction of AI stocks in the wake of a recent sell-off. Investors are assessing the sustainability of the AI boom, which has faced scrutiny amid geopolitical tensions. A strong showing from these companies could help stabilize the market, while disappointing results may exacerbate existing fears. The stakes are high as the tech sector navigates through a challenging economic landscape. Upcoming earnings reports from both companies will provide deeper insights into the resilience of the AI narrative and its implications for the broader market. Netflix has reported a disappointing quarterly forecast, leading to a significant drop in its stock price, which fell by over 10%. This development has raised concerns among investors about consumer spending and subscriber growth in a challenging economic environment marked by inflation. The weak guidance from Netflix is viewed as a bellwether for the tech sector's vulnerabilities, particularly as companies grapple with high interest rates and rising operational costs. This decline in share price has contributed to broader negative sentiment across major indices like the Nasdaq and S&P 500, which are also experiencing declines. Investors are increasingly worried that the streaming giant may struggle to sustain growth in an increasingly competitive landscape, especially with rivals like Disney Plus and Amazon Prime Video ramping up their content offerings. The implications of Netflix's performance extend beyond its own financials. It reflects broader trends in consumer behavior amid rising costs. As the tech sector braces for potential headwinds, Netflix's results will be closely monitored in the coming quarters for signs of recovery or further decline. Inflation in the United States has surged to 4.2%, marking the highest level in 3 years. This increase is primarily driven by rising energy prices, particularly gasoline, which have been significantly impacted by the ongoing conflict in Iran. The geopolitical tensions have disrupted supply chains and heightened uncertainty in global markets, contributing to this inflationary spike. The Federal Reserve faces increasing pressure to respond, with indications that rate hikes may be necessary to rein in soaring prices. This situation has raised alarms among economists who worry about the potential for a slowdown in economic growth. Investors are bracing for a volatile market as the prospect of rate adjustments looms large. Higher interest rates could dampen consumer spending and business investment, further complicating the economic recovery. As inflation continues to rise, the interaction between monetary policy and consumer behavior will be crucial. Looking ahead, the Fed's forthcoming decisions will be pivotal in determining whether inflation can be contained without stifling growth or triggering a recession. The ongoing conflict between the U.S. and Iran has created a knife-edge economic outlook, with fears of an oil shock looming over the market. This military engagement, which has roots in long-standing geopolitical tensions, disrupts supply chains and heightens volatility in energy prices. Investors are facing a precarious situation as the potential for an AI boom collides with the risks associated with rising oil costs. The war has significantly impacted global energy markets, pushing inflation beyond 4% for the first time in 3 years, a level not seen since the pandemic's peak. This economic volatility has forced the Federal Reserve to reevaluate its stance on interest rates, considering potential hikes to combat rising prices. Consumer sentiment has been fluctuating, with temporary relief from lower gas prices overshadowed by the uncertainty of the conflict. As companies adjust to these changing conditions, the outcome of this geopolitical strife will likely shape market dynamics in the near future. Investors must prepare for continued instability as they navigate these turbulent waters in the coming months. The semiconductor sector is currently grappling with its most significant decline in over a year, primarily fueled by mounting concerns regarding the sustainability of the recent AI boom. Major industry players such as Nvidia, Intel, and AMD have witnessed their stock prices plummet as investors reevaluate the durability of the substantial gains achieved in recent months. This sell-off has breached critical support levels, with the sector now testing the vital 200-day moving average, a key indicator for market analysts. The transition from a bull market to a potential correction phase for AI stocks appears increasingly probable. The ramifications of this downturn extend far beyond individual companies, as the entire technology sector struggles with shifting investor sentiment and confidence. Futures have slid sharply, prompting urgent questions about the future trajectory of the AI-driven market. Investors are now keenly focused on upcoming earnings reports, which will be pivotal in assessing whether this downturn can be reversed or if a prolonged correction is inevitable. The resilience of chip stocks will play a crucial role in shaping the tech landscape and determining the overall health of the market moving forward. The geopolitical landscape has been dramatically affected by the ongoing U.S.-Iran conflict, creating ripples across global markets. This conflict has historical roots, stemming from decades of tension over nuclear ambitions and regional influence. As hostilities flare, concerns regarding oil supply have escalated, further exacerbating inflationary pressures that many economies are already grappling with. The potential for supply disruptions from the Middle East, a crucial oil-producing region, has sent shivers through energy markets. Consequently, investors are adopting a more cautious stance, leading to a volatile trading environment where stock prices fluctuate in response to news about the conflict. The Federal Reserve is closely monitoring these developments, as they weigh the implications for monetary policy and interest rates. Increased geopolitical risks may prompt shifts in investor sentiment, potentially leading to a flight to safety in the form of bonds or precious metals. As the situation unfolds, the interplay between geopolitical tensions and economic stability will be critical for future market movements. Analysts suggest that if the conflict intensifies, oil prices could surge, further straining global inflation rates. Looking ahead, market participants should prepare for a period of heightened volatility as they navigate the uncertain geopolitical landscape and its economic ramifications. The recent sell-off in chip stocks and AI leaders has raised significant questions about the future of the AI boom. Market analysts are expressing concerns that the surge in AI-related stocks may not be sustainable, leading to a reassessment of valuations. This turbulence has resulted in a sharp decline in major semiconductor companies, prompting fears of a broader correction in the tech sector. Several factors are contributing to this situation, including rising inflation, geopolitical tensions, and the potential for increased interest rates, which have all created an uncertain economic environment. The AI industry has experienced rapid growth over the past few years, driven by advancements in machine learning and increasing demand for automation. However, this recent volatility suggests that the market may be overestimating the immediate potential of AI technologies. Investors are left to ponder whether the AI narrative can continue to thrive or if it is entering a phase of contraction. The outcome of upcoming earnings reports from key players will be pivotal in determining the trajectory of the AI market. Companies like NVIDIA and AMD will be critical to watch. As we move forward, the intersection of technological innovation and economic pressures will significantly influence the future landscape of AI investments, shaping strategies for both investors and tech firms alike. Thank you for watching our top 10 world news stories today. Which story shocked you the most? Don't forget to like and subscribe for more updates.